Usually when you sit down to watch a magic show, you know exactly what you're paying for. Like you're paying to be fooled.
Right. Yeah. You want to be tricked.
Exactly.
Yeah.
You watch the magician's right hand waving this flashy silk handkerchief, and you are completely aware that the real trick is, happening quietly in his left hand. It's a willing suspension of disbelief.
And I mean, nobody minds that, right? Because the deception is the point. You're buying entertainment. So the transaction is entirely transparent to you.
But then you step into the world of modern business, and suddenly you're part of a magic trick without even realizing it. I mean, you buy a flight or you download a free app, open a bank account, and you think you know exactly what the transaction is.
You think you're paying for a seat on a plane,
Yeah,
right?
yeah. Or getting a game for nothing, or just, storing your money. But the real engine making that company rich is happening entirely out of sight, over in the other hand. So today we're decoding those hidden engines. Our mission for this deep dive is to look past the product you think you're buying and uncover the invisible mechanisms where the real value is actually captured.
And to do that, we are pulling from a really fascinating stack of material today. We're looking at some foundational historical context from Wikipedia on business models, a financial breakdown of airline economics from Global Financial Info, and an analysis of insurance profitability from Financial Edge Training.
We've got a lot of ground to cover.
We really do. We also have a comprehensive guide on free app monetization from Adaptee and some great insights on banking margins from Viz Banking. Oh, and we'll also weave in resources from the Cherie Blair Foundation, which is great for anyone looking to apply this kind of structural thinking to their own ventures.
Right. So the fundamental separation we have to establish for you right off the bat is, well, the difference between the product a company makes and the mechanism by which it actually captures value. Because historically, those two things were identical.
Yeah, they were exactly the same thing.
Like a blacksmith makes a horseshoe, sells the horseshoe, captures the value, done. But modern commerce has severed that link entirely.
It really has. And the turning point really started in the early 20th century with what became known as the bait and hook model. Or, some people call it the razor and blades strategy.
Right, the classic Gillette example.
Exactly. This is where a company intentionally sells the primary product, the razor, at a loss. That's the bait. The mechanism for value capture is entirely shifted to the consumable replacement blades. So they aren't really selling you a shaving tool. They are basically selling you a recurring subscription to sharp metal.
Which sparked decades of structural innovation. I mean, you look at the history, and McDonald's revolutionizes this in the 1950s. They appear to sell hamburgers, but the value capture mechanism is actually corporate real estate, leasing the land back to the franchisees.
Right, they're a real estate company.
Exactly. And then Walmart comes along in the 60s and shifts the value capture to just relentless supply chain and inventory squeeze. And Amazon in the 90s essentially turns their own internal IT infrastructure into a product, subsidizing the retail business with cloud computing.
Yeah, and all of those historical models eventually culminate in a massive paradigm shift. Sangeet Paul Chowdhury, a researcher highlighted in our historical sources, describes this as the shift from pipes to platforms. Because for most of industrial history, businesses operated as pipes.
Okay, let's unpack this and give you a visual for this. A pipe is like a traditional water main, right? A company creates a good or service upstream and just pushes it down the line to a consumer downstream.
Right, it's a very linear one-way flow.
Yeah, you manufacture a television, you put it on a truck, it goes to a store, someone buys it.
But a platform completely abandons that linear pipe. Instead of pushing a product down a line, the company provides the infrastructure, they build the arena, provide the tools, and they just act as a matchmaker to connect different groups of users who create and consume value with each other.
So they don't even make the thing being consumed.
No, not at all. The company captures value not by selling a product, but by orchestrating the ecosystem and, taking a toll on the interactions.
Which is like building the town square itself. Rather than trying to open a bakery on the corner, you just charge a tax on everyone who comes into the square to trade.
That's a perfect analogy, yeah.
And this pipes versus platforms concept, it kind of sets us up to expose our first massive corporate illusion. Because they're these massive capital-intensive industries that look exactly like linear pipes to the consumer. You buy a flight, you get on the plane.
But behind the scenes, these companies have had to engineer entirely different invisible value capture mechanisms just to survive.
Yeah, and the airline industry is the perfect case study here. If you look at the economics, it is a notoriously brutal sector.
Oh, absolutely brutal.
The numbers from Global Financial Info are staggering. Airlines carry about 4 billion passengers every single year globally. $4 billion. Yet historically, airlines are famous for being one of the worst businesses in history by cumulative profit.
Yeah, the capital expenditure for aircraft is massive, fuel costs are wildly volatile, labor is super expensive.
And you're selling a perishable commodity. Once that cabin door closes, an empty seat has lost revenue forever. I think Warren Buffett famously called the industry a death trap for capital. So how do they survive what the source calls the miracle of breaking even?
Well, they survive because the price you pay for your seat is almost irrelevant to their actual profit engine. The first layer of survival relies on yield management and unbundling.
Right, dynamic pricing.
Exactly. Yield management is this incredibly complex algorithmic process of parsing minute data points to extract the absolute maximum willingness to pay from every single passenger. The person sitting right next to you might have paid half what you did for the exact same physical product.
Just because the algorithm detected they bought on a Tuesday 3 months ago, well, you bought on a Friday 2 weeks out.
Right. And then the unbundling is where they strip the product down to the studs. A ticket used to include a bag, a meal, a seat assignment. Now the base fare is just bait to get you into their ecosystem. The actual margin hides in the ancillary revenue.
Charging you for the check bag, the priority boarding, the 2 extra inches of legroom.
Yeah. But the real revelation in the global financial info analysis has absolutely nothing to do with planes. The biggest secret of the major legacy carriers is that they're essentially operating as loyalty-based credit card banks.
Okay, wait. I need to push back on this. Because if the loyalty program is the real asset, why do they even bother flying? I mean, why take on the massive overhead of buying jet fuel and maintaining a fleet of Boeing or Airbus planes if the money is all in the credit cards? Why not just become a bank full-time?
Because the planes are the necessary illusion, right? They are the marketing expense that makes the currency valuable. Here's how the mechanism actually works. Airlines partner with massive financial institutions to offer branded credit cards. The airline prints its own currency, the miles, and sells those miles to the bank for actual cash at a massive premium.
Oh, wow.
Yeah, and then the bank awards those miles to you as an incentive to use their credit card so the bank can collect swipe fees from merchants.
So the airline gets a massive, high-margin, predictable stream of cash from Wall Street banks, completely disconnected from the price of jet fuel or a pandemic stopping travel.
Yes, exactly. For many large airlines, their loyalty program is routinely valued higher than their entire physical operations. The frequent flyer program is the actual business. Flying the planes is just the loss leader that makes you want to accumulate the miles in the first place.
That is wild. You think you're paying a transportation company, but you are actually engaging with a highly sophisticated fintech firm.
Pretty much, yeah.
It's just crazy that airlines survive by monetizing a future liability, those miles they eventually have to honor. But when you look at the insurance industry, they do the exact inverse.
Right, they flip it on its head.
Yeah, they monetize the present moment, that massive pile of cash sitting in their accounts before a liability even occurs.
The insurance model is brilliant in its hidden mechanics. The common assumption is that an insurance company makes its money through underwriting profit. Like, you pay your premium, and as long as the company collects more in total premiums than it pays out in claims to people who crash their cars or damage their homes, they make a profit.
Right. So let's walk through the math from the financial edge training analysis to see why that assumption kind of misses the real engine. Let's say I pay you £1,000 for a year of car insurance. How much of that is actual profit from the policy itself?
Usually, very little. Actuaries model the risk relentlessly, and they might operate with an 80% loss ratio. That means out of your £1,000, they fully expect to pay out £800 to cover claims across their customer base. They only keep £200 as underwriting profit.
Okay, I mean, £200 on a £1,000 policy is a decent margin, but it definitely doesn't explain the massive skyscrapers with insurance logos on them in every major city.
No, it doesn't. The skyscrapers are built on investment income. When you pay that £1,000 premium on January 1st, they don't just put it in a vault. They hold that cash for the entire year before they have to pay out those anticipated claims.
Ah, the float.
Exactly. In financial terms, this pool of money is called float. They take billions in float and invest it in the financial markets.
Here's where it gets really interesting, though. If they take my premium and pump it into the stock and bond markets, aren't they basically operating as a massive hedge fund that just happens to sell car insurance on the side to generate capital?
That is exactly the mechanism. If they take your £1,000 and achieve a 15% return in the markets over the year, they make an additional £150. So the underwriting gave them 200, the market gave them 150.
Wow.
Yeah, nearly half of their total profit on your policy didn't come from insuring your car. It came from playing the market with your money before you needed it back.
Which seamlessly leads us directly to the ultimate managers of capital. I mean, since insurance companies rely so heavily on investing other people's money, we have to look at banks. How do they capture value? We all know the basic premise. Banks charge interest on loans and pay interest on deposits.
Right, but the Viz banking source gives us the actual diagnostic tool for how they survive, which is a metric called net interest margin, or NIM.
Okay, break that down for us.
Net interest margin is essentially the heartbeat of a bank's profitability. The calculation is actually pretty straightforward. You take their interest income, which is the money they generate from issuing mortgages, business loans, holding securities, and you subtract their interest expense, which is the money they pay out to you for keeping your deposits in their savings accounts.
Right.
You divide that net number by their average earning assets, and you get the M.
And if you're listening to this and wondering why bank profitability metrics matter to your life or the broader economy, it's because NIM dictates how willing a bank is to actually lend money to you or your business.
Absolutely. And NIM is heavily dependent on macroeconomic forces, specifically the shape of the yield curve. A bank's ideal environment is a normal, positively sloped yield curve. This means short-term interest rates are lower than long-term interest rates.
So they borrow short and lend long.
Exactly. They take your deposits and pay you a low short-term rate, and they issue a 30-year mortgage at a much higher rate.
So when that curve flattens or inverts, like we've seen in recent economic cycles, where short-term rates spike, their interest expense just skyrockets.
Yeah, they have to pay more to keep deposits, but they are locked into long-term loans paying lower yields. Their margins get violently squeezed, and borrowing money suddenly gets harder and more expensive for everyone.
But what the Viz banking data reveals about who actually manages this margin best is deeply surprising. It's totally counterintuitive.
It really is. You would assume the trillion-dollar Wall Street titans have the ultimate advantage here.
Right, they have infinite scale, massive trading desks, access to global capital. But the data shows your local community bank is actually operating with a higher net interest margin than the mega banks. I struggle to see how a local bank with 3 branches outmaneuvers a global conglomerate.
Well, they win on margins specifically because they avoid the commoditized, high-volume arenas where the mega banks fight. Community banks focus on relationship lending and highly specialized local niches.
Oh, so they just know their market better.
Exactly. A local loan officer understands the specific dynamics of, say, agricultural equipment loans in their county way better than an algorithm in New York. Because they offer specialized knowledge and relationship-based service, they can often command slightly higher rates on their loans.
And on the flip side, their deposits are sticky.
Precisely. They rely on highly stable, lower-cost deposit bases. People keep their business accounts or personal savings in their local bank out of loyalty, convenience, and community ties. They aren't constantly moving their cash around to chase a 0.25% higher yield on the internet.
Which means the community bank's interest expense stays remarkably low and stable, padding that net interest margin.
Exactly.
So far, we've been looking at heavy, capital-intensive businesses. Airlines deal with billions in physical planes, fuel, and labor. Banks and insurance companies manage massive regulatory overhead and physical branch networks. But the entire concept of value capture kind of shatters when you move to an environment where the product costs absolutely nothing to duplicate and distribute.
The digital economy, yeah. When the marginal cost of producing a second copy of a software application is effectively zero, the traditional rules of commerce just disintegrate.
We are looking at the Adapti source on monetizing mobile apps, and if there's one statistic that defines this digital gold rush, it's this. 98% of all mobile app revenue worldwide comes from apps that are entirely free to install.
It's crazy when you think about it.
98%. It is a complete inversion of traditional business.
Well, if the product is given away for free to billions of users, the value capture mechanism has to be entirely decoupled from the initial transaction.
Right. And when you look at the monetization data across the app economy, the dominant strategy is advertising, which generates 67% of global mobile app revenue. But it's not just about, plastering a digital billboard on your screen. The mechanism relies on different tiers of user attention measured by eCPM, or effective cost per thousand impressions.
Yeah, and the ECPM disparity is where you really see how attention is valued.
Hmm.
If an app uses a traditional banner ad, that little graphic sitting at the bottom of your screen while you read an article, it generates microscopic revenue. On iOS, a banner ad might command about 45 cents per thousand views.
It's just digital loose change.
Basically. Yeah.
Uh, the value capture explodes when they can guarantee your actual engagement.
This is the rewarded video format. If a mobile game offers you an extra life or premium in-game currency on the condition that you willingly watch a 30-second ad, the economics change completely. That format commands roughly $19.63 per thousand views on iOS.
That is a massive jump.
Huge. Users tolerate the interruption because they opted in for a tangible reward, and advertisers pay a massive premium because they know the user's eyes are actually glued to the screen, waiting for the timer to count down.
All right, they can't just scroll past it. Then you have the subscription model, which presents a fascinating paradox in the adaptive data. Only about 4% of total mobile apps even attempt to use a recurring subscription model. Yet, that tiny 4% accounts for 45% of total global app revenue.
Subscriptions are the holy grail of value capture because of that compounding recurring revenue. But the psychological barrier is immense. Users expect software to be free. The data shows a punishing 30% cancellation rate in the very first month for annual plans.
Wow, 30%.
Yeah, you cannot just lock someone in. You have to constantly justify the recurring charge by delivering continuous value updates. Otherwise, the churn rate will just destroy your business model.
Which is why the AI boom is so disruptive here. The source highlights ChatGPT, which uses a tiered subscription model, and the revenue numbers are defying typical app gravity. After 60 days, ChatGPT generates an estimated 63 cents of revenue per install. The median for the rest of the app ecosystem is just 31 cents.
And it's double.
Yeah. AI has managed to normalize paying for digital utility in a way standard apps have struggled to do for a decade.
And because relying on a single mechanism is dangerous in a fast-moving digital market, developers are increasingly migrating toward hybrid models. In fact, 35% of apps now mix their value capture. They offer a free ad-supported tier, a premium subscription to remove the ads, and one-time consumable purchases within the ecosystem.
But if you're building an app or just looking at this ecosystem, there is a fascinating demographic detail, a massive operational divide you have to understand. iOS generates 67% of total consumer spend globally, despite having a much lower market share than Android devices. Why is Apple's ecosystem so much more lucrative for developers?
The answer really lies in the friction of the underlying infrastructure. Apple runs a tightly locked, highly standardized payment fortress. Every user has an Apple ID tied to a valid credit card. The transaction is completely seamless.
In Android.
Android, by contrast, is a highly fragmented Wild West. It operates across thousands of different device types, hundreds of carriers, and a patchwork of global payment gateways and third-party app stores.
And that friction literally bleeds money. The data shows Android suffers from a massive 28.2% billing error rate, meaning more than a quarter of attempted transactions fail to process. iOS sits at just 15.1%.
It doesn't matter how good your product is if the pipes underlying the value capture are leaking.
Exactly. It illustrates that operational mechanics, like global payment processing, are just as critical to survival as the software you're trying to monetize. So, what does this all mean for you, the listener? Let's visualize what is happening to you as a consumer in this free digital economy. It's like getting a top-of-the-line security system installed in your house for absolutely free.
Okay, I like this.
The cameras, the sensors, all zero cost. But the catch is, the security company legally owns the floor plan of your home. They know exactly what time you leave for work, what time you go to sleep, and they monetize that free system by selling your behavioral schedule to door-to-door salesmen and data brokers.
That's a bit terrifying, but it highlights the core truth of the platform economy perfectly. If you aren't paying for the product, you are the product. Though it is crucial to note that data monetization is no longer a completely lawless frontier.
Right, there are rules now.
Yeah, frameworks like GDPR in Europe and CCPA in California enforce strict privacy compliance, requiring explicit consent and giving users opt-out mechanisms. But still, the underlying engine, aggregating and monetizing behavioral data, remains the most powerful hidden profit center in the digital world.
We have covered incredible ground today. We've gone from the algorithms pricing your airline seat, to the insurance companies trading your premiums on Wall Street, down to the community banks leveraging local loyalty, and finally into the invisible data economies hiding behind the free apps on your phone.
And when you synthesize the mechanics across all these diverse sources, the ultimate takeaway is the decoupling of creation and capture. Offering a game, flying a plane, holding deposits, the act of creating value is the public face of the business.
The shiny silk handkerchief.
Exactly. But the act of capturing value, farming ad impressions, selling credit card miles, investing float, that increasingly happens in a completely different, invisible arena.
And if you are listening to this and you happen to be an entrepreneur or you are thinking about building your own venture, you really need to structure your thinking around this reality. You don't have to guess how to build these models. The e-library from the Shuri Blair Foundation is an excellent resource mentioned in our stack that provides concrete guidance on exactly this kind of structural thinking and developing robust value capture mechanisms.
Because knowledge of these systems truly empowers you. Understanding the why and the how behind corporate profitability changes the way you interact with the economy. Whether you're trying to build the next great platform or simply trying to navigate the world as a consumer who refuses to be fooled by the illusion.
Which leaves us with a final provocative thought for you to carry with you long after this deep dive ends. We've seen airlines abandon their core identity to become credit card banks. We've seen software developers become massive advertising networks. As technology accelerates this trend, what happens when every company eventually realizes they can generate vastly more margin by selling their customers' attention or financial loyalty than they ever could by selling their actual core product? Will pure businesses, a company that just makes a good thing and sells you that thing for a fair price, even exist in 20 years? Or will every single corporation on earth eventually just become a financial services or data advertising firm wearing a very clever disguise? Next time you watch that flashy silk handkerchief, ask yourself, what is happening in the other hand? Thanks for diving deep with us today.